market turns, or at least the way that I do it, is a question of, look, a market hits a bottom when everybody's short, okay? A market hits a top when everybody's long, right?
Yeah.
So I'm trying to, how do you measure when everybody's short, when everybody's long? So the commitments of traders is one piece of data that can help you do that, because it's not a survey data. You know, people like to look at these surveys, AAII, oh, the large amount of bears, or they look at the CNN fear greed index, oh, it's low, and that's all great, but the commitments of traders is actual money, right? It's showing positioning. It's like a gift they're giving us, right? It's showing what positioning is. So this helps greatly in determining that concept of, is everybody long, is everybody short? So that's what I use the commitments of traders to do. And I have to tell people, it's no magic thing, you know, it's anything else, right? It's one of these things where at market lows, the commitments of traders will show that everybody is short. At market highs, not all the time, but a lot of times. At market highs, the commitments of traders will show that everybody is long. However, it might be showing that for a month before the lows, right? So yes, at the lows it will be there, but it might also be there way before the lows, right? In which case you're going to get run over if you just trade off of that data. So I use this data as a screen to keep me out of trouble more than anything else, right? Like here, I'm not going to buy until it shows this, but I'm not going to buy just because it shows this, right? So that's kind of what I use commitment of traders to do more than anything else. And just like just about all my trading, I need it to keep me out of trouble. If I can stay out of trouble, then maybe I have a chance of making money over time.
Yeah. You know, that's so interesting. I think that's such a underappreciated point. People look at indicators as some magic pill to get them into trades, but actually, the true value of the indicator is as a magic pill to keep you out of stupid trades. You know,
not trading is many times the single best trading there is. I'm a counter trend trader. This is a perfect example, right? I'm a counter trend trader. I don't really call it counter trend because I'm not looking at price, and trend is a price thing, but for argument's sake, let's call it counter trend here. Trend right now is king, right? Look at the bonds, look at the stocks, look at the dollar, right? I am not up money this month. I'm down a little bit, which in my view it's never okay, but it's sort of okay because trend following is killing it, right? So me being down 30, 40 basis points is fine. And the reason that is because I have been not trading, right? That's been the best trade I've made this entire month, is not trading.
I can't tell you how many times in my life I have front run my indicators. I'm like, well, it's close, it's setting up, and you know it's going to turn, or it's about to break out, it's close. And that is a 9 out of 10 times regret trade. That is, even when you're right, you're always wrong because you're right only once out of 10 times.
It'd be better if it was 10 out of 10 because then you stop doing it. That one time keeps you doing it, right?
It's kind of like RSI. You normalize it to a 0 to 100 reading. And when it goes to 100, that means everybody is long, and when it goes to 0, everybody is short. Is that kind of the right reads?
There's an oscillator for both the commercials and the speculators, which are equal and opposite. So if you're talking about the speculators, when it's at 100, that means everybody's long, and when it's at 0, everybody's short. It's going to turn here. When are the market's going to turn here? My answer is as soon as you stop asking me that, okay? As soon as everybody stops asking me that. Everybody is trying to trade the turn here. Everybody's trying to trade. By definition, it can't come if everybody's trying to trade.
Right. So that's one component of it. The other component that's very interesting is that you have an interesting fundamental overlay on your process, which is I think the really, the true sauce of the recipe, which is that you wait for what I call a fundamental failure. And a good example of a fundamental failure would be, we're just going to play this forward. It's an imaginary example, so nobody take me seriously. So let's imagine October CPI comes out and it's still hot, like it's 8.2, 8.3, it's still a hot number, but the market actually rallies, doesn't decline, and bonds actually fall. They don't, or bonds yields actually drop. They don't fall. Like something that seems so obvious, yet the opposite happens. That's an interesting tell for you, right?
That's the tell for me. And that's the only times I will make a trade. It's one thing, okay, everybody's short. Okay, that's great, but the market, they can keep getting shorter. There's never everybody short, right? My oscillator will say, okay, on a relative basis, everybody's short, but relative can change, just like an RSI. Okay, it's oversold at 5. Well, it can go to 0, and then it can stay at 0 for a long time. So that's one thing, and that's great. But I won't put on a trade until we get what you're talking about. So if my oscillator is showing, okay, everybody's short here, I'm looking to get long something, now I'm waiting for the market to give me this tell, which is what we call a news failure event. So if the oscillator is showing that, now I'm paying very close attention to that particular market and what is driving, in theory at least, this fundamental. So if we want to argue that right now the fundamental is inflation, although I don't personally think it is anymore, and because I think that everybody is convinced that inflation is coming down now. I mean, we see oil prices, we see housing, we see used car prices, we see everything, right? So I don't really think that is the problem anymore, but let's, for argument's sake, say it was the problem, okay? Inflation. So like you say, inflation is what's driving this thing down, all right? Or let's even look at it as 2 years is what's driving this thing down, which is a function of inflation anyway, right? So you have some news come out, 2 years get blasted again, right? Very bad stocks. And stocks are showing that speculators are massively short. And stocks end up going down, most likely, and then they close the day up without the 2 years rebounding, without any other news coming out. And it's like, well, gee, why did stocks close up today? Didn't everybody see the news? Doesn't everybody see the 2 years? And the clear answer is yes, everybody saw the news. You got millions of people trading these markets, right? And paying attention. And everybody saw the 2 years, and everybody sees all this. So why is the thing up? And I can tell you the answer is not, oh, because these people don't understand what's going on. That's not the answer, right? The answer is because everybody is already short, right?
You have a lot of samples. So like, competence breeds confidence, right? The idea is that you've had a lot of samples of this. And because you've had a lot of samples, you now have confidence that even if you have, 4 or 5 or 6 stop outs in a row, the process is still valid. It's still valid. Nothing has really changed. It's just simply, market dynamics that clip you out, right?
Yes, and it's also a combination of yes, I can look at my P&L and say, okay, clearly it's been working at least to this point in our lives, right? Things change, and maybe one day it won't work. But I believe so much in the whole, forget about markets. I believe so much in the concept of when everybody is doing the same thing, right?
Yes.
The reward is skewed the other way. I mean, you'll never convince me otherwise. It doesn't matter if it's markets or if it's gambling or whatever it is in life, right? When everybody's thinking the same way,
yes,
the odds are skewed the other way.
How do you combat the need for speed, the need to be in the market when you don't, I don't know, could you ever go like a couple of weeks without any signals, without any setups? Like, how do you keep yourself from doing non-process oriented trades, which is like a term I just came up with? But I used to, Bob Pisani on CNBC used to always say it's a non-market sensitive buyer, which means somebody who didn't care about the price, they were just blowing through the thing. That's, I think, is what all of us as traders do. This when we do a non-process sensitive trade, it's just we're just doing shit for shit's sake instead of actually doing a setup trade. What do you do like in that situation?
That's become very easy for me. I don't want to. If I feel like reminding myself about how I do process trades, then I'll just go out and do a non-process trade, and I'll lose money, and I will kick myself the entire freaking day and the entire night. Okay, and I get right back to it. I hate putting on trades. Okay, people love it, right? They love it. They want to trade all the time. I hate it. One of the good things, I run a CTA now, and I started this one a few years ago. And I don't have any employees, so I have to do the back office stuff, right?
Okay.
I hate doing the back office stuff. I mean, it takes 10 minutes, right? I have to download this and send out these sheets. I hate it. If I trade, I have to do the back office stuff. That helps me right there, right? But truthfully, I don't, at this point, I mean, I'm 55, I'm doing this a long time, right? At this point, I don't need that stuff. I hate putting on trades. So it's easy for me to put on non-processed trades. And that's my job.
Why do you hate putting on trades? Like, what is, like, you mean, is it just
all the time? Okay, you know what I mean? I have the same weaknesses as everybody else. You're chasing. Oh, you fear of missing out, this and that, right? What I love doing is putting on trades that fit my process, because then I think that I have a risk-reward advantage in that.
Okay. I just
putting on other trades and playing the game to play the game.
So if it's a 1 to 3, it's a 33% or 37% win rate, whatever it is, but it's a 4x return when you hit it. How do you take profits? Like, how do you're obviously trying to buy the turn. When do you exit? Like, what's the process for the exit?
So again, let's think about what the process is. I'm getting long because everybody's short.
Right.
When do I want to get out? When everybody is not short, right? So essentially means when my oscillator gets back to zero, right?
Okay, but here's a quick question.
When my oscillator gets back to 50, when it gets back to neutral, my edge is gone, so I'm out. Now, over time,
so the oscillator goes from 0 to 50. You're exiting at 50, not even at the full over. You buy it when it's oversold. You don't wait till it's overbought. You get to neutral. You get rid of it.
So when we tested this stuff, what it told us was we should do, if we want to maximize profit, we should do what you're talking about. Buy it at 0, wait the whole way until it gets all the way to 100,
right,
and then sell it. That's going to maximize our profit, okay? But there's 2 reasons why I don't do that. One, we found once it gets past that neutral rate, the volatility of that return goes up much more than the relative return that I'm earning, okay?
Right.
I'm not interested in that, first of all. Second of all, getting back to what my job is, right? My job is to catch that. Once you get to 50, well, now the trend followers are getting on board. That's their job, right? And if I do that, I'm gonna start becoming much more correlated to trend followers, and I don't want that. That's not what I do, right? So,
yeah, for lack of a better expression, stay in your lane is sort of your message. Basically, you know exactly what you do. It doesn't matter that it can go 40x from your exit. That's not your domain expertise, because it can also go to 0x, and you gave up. You as you said, you're collecting so many losers. You really have to have decent winners to pay for all those losers. So you don't want it to go from 3.5x back to 0 and give back the one profitable trade that you had in that sample size. So it doesn't matter that it goes, that thing could be a runner to 40x. You know your process, and the whole idea is to repeat it consistently, right?
That's the idea. That's what I have to do. That's what I try very hard to do.
This is somebody clearly from my room asking, because I do nothing but the general.
Okay, these are I would call medium term to long term market tops and bottoms that I'm picking. So my typical winning trade, my typical losing trade lasts a week. I buy it, it goes through lows, I'm out, right? My typical winning trade lasts 2 to 4 months, right? And sometimes it lasts longer. It's not up to me, it's up to them. If they're all short and I buy it, then I'm just waiting for them to get out of those shorts. Usually it's a 2-3 month squeeze, sort of like what the June rally in the S&Ps was, right?
Yeah.
June, we were out by August somewhere, right? But sometimes it lasts a hell of a lot longer. Usually in things like fixed income, it lasts a hell of a lot longer. You have three major indices: the Nasdaq, the S&P, and the Dow, right? The Nasdaq is the most volatile, or has the highest beta. The S&P is second, and the Dow is third, right?
Yes.
So to me, you have 3, well, let's call them 4 type of days. One day is random day, so let's just forget about it, okay? Because you're not going to trade random day, okay? One day is trend up day, okay? So the market's going up. So on an up day, what you need to see is the most volatile thing being up the most, right? The highest beta should be up the most. The Nasdaq should be up the most. The S&P should be up the second most, and the Dow should be up the third most. And as long as that's going on, as you're watching it, then that's an up day and you want to be long, right? Short side, the opposite. It's a downtrend day.
Right.
And that should be the weakest. That's S&P should be the second weakest, Dow should be the third weakest. And as long as that is going on, you should be wanting to short it. Now, how you want to short it and where you want to short it, you want to short a bounce, you want to short this, you want to short your technical levels, that's up to you, right? But in general, if that's what it looks like, you want to be shorting that day. Then you get the fun days, which are the turn days, right? So the market's down, and yet the NASDAQ is down 1%, the S&P is down 1.3%, and the Dow is down 1.5%. Well, that's wrong, okay? That's not what's supposed to happen on a down day. And that's how turn days look, right? All of a sudden, you'll get halfway through the day, and the NASDAQ is outperforming on a down day. That's the days you want to get long and watch for the rebound. And this works. You have to, this is the general concept of how to do this.
Yeah.
You're now going to have to go and figure out the best way to do it, right? But I can tell you right now, that's a gold mine.
Wow. Thank you. You know what?